This looks like a better than expected report. Markets are worsening, I guess, on the idea that the Federal Reserve will keep raising interest rates. Charles Payne, you react.
This is exactly what I said, the wages, right? So 2.9% is the number that we got on February 6th when we got the January jobs number. That day, the Dow Jones Industrial Average was off 666 points. So we'll see what happens. Again, though, between what, and John could obviously talk to this, but between what I heard from the Jackson Hole commentary from Jay Powell and yesterday, the second most powerful member of the FOMC, John Williams, becoming a lot more dovish in his speech in Buffalo, I think that the Fed is going to be okay with allowing Main Street to get a long overdue pay raise.
Now, Lisa Erickson, you were expecting a good number. You got it. What else in this report strikes you?
Yeah, it really is a very good number, as you're saying, Maria. And I think really, again, the key figure that came out of that was that 2.9% year-over-year increase in wages. And though it was slightly above expectation, it's not really out of the wheelhouse. I think what you're looking at is we've had some delays in seeing some wage gains. And really, since then, what you've seen is a steady upward increase in that wage gain number. And so while, again, it's a little above expectations, it's not totally unexpected and is continuing that trend of really overall modest gains in worker earnings.
And the participation rate at 62.7%. Your thoughts on that, Kevin Keller?
Yeah, I think this is reaffirming what we got from the ISM numbers earlier that was super hot, that the economy's on fire. August is traditionally a weaker month when it comes to jobs, and we got 204,000 in the private payrolls, and then you're also seeing the U6 number at 7.4%. That's showing that companies, so the ISM report, I mentioned it because the new orders index is at almost an all-time high, and the ISM is at the highest it's been for over a year. And so companies need to hire people, and this is playing out. I mean, this is an unbelievable number on the U6 labor participation as well as the private payroll.
They're looking at a good unemployment number. It didn't change, Dagan, but 3.9% is pretty good, and the wages at up 0.4%.
Right. The wage gains were solid, as Charles was talking about, 2.9% year-over-year gains. But the revisions to the prior 2 months, I think Edward said, I'm waiting for like the right through. Edward said it was lowered by 50,000 jobs over a 2-month period. That will lower the average that we've gotten so far this year. And so that is a point of concern.
Stephanie.
The last 3 months brings the average roughly to 150, which is down from 225 or so prior to this. So the recent average is definitely down. My other comment would be that as far as the Fed's concerned, that hotter average hourly earnings number brings you just to zero in terms of real wage growth. CPI of 2.9 is equal now to wage growth of 2.9. So I don't know that that's necessarily impetus for the Fed to come in here if that's why the market's
I'll push
down.
back on that because that's become a Democrat narrative in the election, that the economy is going great guns, but they're going to focus on the inflation number. Because it's the summer, because that consumer price index number reflected energy prices. If you look at the PCE, up 2.3%, the core PCE is up 2%. So we found out in the most recent personal income and spending numbers that disposable income adjusting for inflation is growing 2.9%.
Yeah, it depends on the categories.
Right.
We just heard from Kraft Heinz, and the increases in costs are significant at Kraft Heinz, but not so at other companies. So it's bifurcated in terms of the impact.
Absolutely. The other side of the wage increase in this number, though, is that it's normal to expect hotter wage growth when manufacturing is that large a contributor, because manufacturing jobs tend to be higher paying jobs. So it's not surprising, given the, 41,000 increase in the manufacturing number, that you got a stronger wage figure associated with that.
There's a breakdown in the August report of really where the jobs were, Joni Courtney, and we're looking at service providing jobs up 178,000 in the month. You also had construction up 23,000, but interesting to note, a decline in jobs in manufacturing and a decline in jobs in retail. Your thoughts on where the jobs are right now, Joni?
Yes, you know, Maria, this number is great, and I think it actually could have been even stronger. There is a strong demand, certainly, in many sectors. Transportation, logistics, we've seen retail start to come back. Healthcare continues to be very strong. So there's a tremendous amount of job opportunities, but employers are still having a really hard time finding talent. And so that's why I say over 200,000 jobs created is a really strong number. And it's great to see wages moving in the right direction. I think we're going to continue to see that certainly be a trend for the next few months, just because the job market is so tight right now.
Jason Pride, weigh in here. Your reaction to this report.
So, yeah, I've got a couple of things to say. I think we need to put context around this. Number one, as Dagan pointed out, I think it's exactly right. You need to recognize the fact there were downward revisions in July and June on top of the beat in August. And that, I think that actually muddles this report a little bit. It's still a good report, but it's not like a beat the expectations sort of jobs number. It's just kind of right in the wheelhouse of what we were thinking, which is pretty good labor market, pretty decent job growth, unemployment rate really tight, employers generally having a hard time kind of filling their rosters. There's more job openings out there than actual job seekers, which is creating kind of an interesting stress in the market. In theory, it should be leading to higher wage pressures. We're really seeing, I guess, a little bit of signs of that. But I think there's an offsetting factor here that's really important that we haven't really discussed. And that's there's this age wave that's distorting the wage picture that we have, where you have more expensive, higher earning workers gradually exiting the workforce, newer workers coming into the workforce, that distorting effectively and lowering the wage growth from what it would naturally otherwise be, and actually kind of maybe keeping the inflation in a little bit and working perhaps a little bit to the Fed's advantage and giving them breathing room through this period. It's keeping the numbers from being higher than they would otherwise be at this point. The other thing that I would say, one thing, maybe I'm a little bit of a critic of the employment report. This is one of the most heavily revised government statistics that is provided to the marketplace. I know we all focus on it. I know it's very important because of the details that are effectively provided in it. But it's very likely when we turn around a month from now and read the data that we're going to be looking back at the August report and saying, wow, it's actually 50,000 jobs different than what we said last month. You have to kind of put into the context of the broad economy.
All right,
this is
it's a good
decent
point.
economy.
We will see
Employment's
revisions.
Good, and labor markets are tight.
Certainly, they are tight. John Hilsenrath, markets are trading down. What's your take?
I mean, I think markets are trading down because you saw this wage number go up without any increase, and with the labor force participation rate falling a little bit. You know, I think the market sees some inflation wage pressure that the Fed might have to respond to. That's the Wall Street response, kind of not so great. The Main Street response, I think, is pretty good. We have a very low unemployment rate, and the economy is still churning out jobs, and we're getting more wage increases. So for Main Street, it's a good number. For Wall Street, a little bit to be anxious about.